Okay, we've been looking at mergers, and today we're going to look at, in a couple of lectures, we've been looking at mergers. And I took you through this whole merger process, right, which was that we first identify the different, the reasons, the why. Why do we want to merge and what kind of merger? So is it a vertical, is it a horizontal, is it a conglomerate? Why is it that we want to find a company to take over? Then we looked at identifying the specific company, and once we've identified the company, we then did financial analysis. After financial analysis, and we've then identified targets, let's say there. Identify targets, do financial analysis to look at risk. We're looking at performance risk. We're looking at risk and profitability when we do performance financial analysis. And then we did valuations. And we spent a bit of time looking at valuations. We looked at the different principles around valuations. And we also looked at valuations from a merger perspective, isn't it? In a merger perspective, valuations include synergies, and the value of a business to the seller is different to the value of a business to the buyer because of these synergies that the buyer finds in this takeover target. And so we started off looking at a number of lectures where we looked at that. So we looked at valuations by itself, then we looked at valuations with synergies, and today we're going to look at almost the last step, which is then looking at how we finance a merger, financing of a merger. And I maybe should have written that in a different color. But essentially there are really only a couple of ways that we can finance a merger. We can use cash, or we can use shares, or we can use a combination of cash and shares. Yeah? Let's just say combo. When we use cash, we can either use cash from cash that we have in the business, but that's highly unlikely because if you think of a merger, we had to have a lot of cash left over in a business, isn't it? And companies don't normally have that much cash every year that they can keep in a business. And so therefore, when we are looking at having cash, we're really looking at either doing a new issue of shares, doing a rights issue of shares, or so we can either do a new issue, which is new shareholders. We can do a rights issue, which is existing shareholders, right? And we can do new or rights issues with ordinaries or pref shares. Or, and this is the third sort of option, we can use debt. We can borrow the money. Yeah? It is less likely that you will use debt to do financing in a merger situation, because if you remember our scenario with financing, we're looking at matching, isn't it? So if we did use debt, it would most likely be very long-term, convertible type debt, isn't it? If I did use debt, or if I used preference shares, it would be very long-term, non-redeemable or convertible, right? So essentially, when we're looking at merger financing, we're looking at very long-term financing, and that long-term financing is share issues, yeah, is equity, predominantly equity. And when we are making this decision about financing, what we do is we look at the different options, just like we did when we were making decisions about how to finance machines. Do you remember we had a lecture where we looked at should we lease or should we do a debenture or should we borrow money from the bank, and we did that NPV calc, isn't it? Now, it's difficult to do an NPV calc with this financing. Why? Because it's forever, isn't it? So, but we do look at different things and we assess. Essentially, when we're making this decision and we're trying to decide which one which one do we do of all of these, we ask ourselves the question, how does it impact existing shareholders? Yeah. So up here somewhere is the existing shareholders of the company, and we ask ourselves this question about what is best for them, because they are the people that you're trying to grow the business for, isn't it? So in your handout that I gave you a couple of weeks ago, there's an example. Let me actually pull it up. I didn't do that. Desk. It's here. All right, so if I just come back here, in your handout, you'll see at the bottom, if you've got it, you don't have. Some of you have. You can just pass it around. You guys have? It was, I think, the very first time we looked at mergers. I gave you this handout, which talked about the different types of mergers and the synergies and all of that. And then on the back of that, there's a section about how we finance mergers, a little section on how we finance mergers, yes? You've got? Okay, so you'll see that on the back of that I talk about financing of a merger, which is that we can either use cash, shares, or a combination. These are the three methods. And when we're looking at cash, how do we get this new cash? We can get it through a new issue, a rights issue, or through borrowing, through debt finance. And when deciding which one we do, we consider those shareholders up at the top there, isn't it? And when we're looking at shareholders, these are some of the things we look at. These are the things that affect shareholders. How is this financing method affecting earnings per share? How does it affect dividends per share? How does it affect the PE ratio? How does it affect the share price? How does it affect return on equity? We look at all of those, isn't it? So the example that I have for you is an example that does exactly that. And it has a company, the example is a company, a big company, company A, that's looking at buying a smaller company, all I did was that. That's looking at buying a smaller company, company B. Company A has a 6,000 Rand market value, or million. Company B has 1,000, 600 issued shares, 200 issued shares, the price per share 10 Rand, the price per share 5 Rand. Company A wants to take over Company B. The combined value will be 8,000. You can see a synergy there, isn't it? Value of A 6, value of B 1, value of A plus B 8, not 7. Yeah, there's your synergy. Company B has agreed to a price of 1.5. So that synergy of 1, they've agreed to just split it down the middle. You get half, we get half. Yeah. So Company B has agreed to a price of 1.5. So the first option that we have is to issue shares to existing shareholders. That is usually the best option. It's the quickest. Yeah, you do a rights issue, you just send a letter to existing shareholders offering them shares. And if they take up shares, then it's done quickly. It doesn't dilute control. Do you agree? Existing shareholders are still taking up shares, and they get offered shares in proportion to existing shareholding. So they don't lose control if they take up their shares in proportion. So there's no loss of control. It's quick, it's cheaper, there's no time delay, there's no costs of doing new issues. So usually this is the best one that you find. But it obviously does depend on existing shareholders having the money, because maybe they've already put all their money into the business and there is no more money. So if they do issue shares to existing shareholders, the price per share is currently 10 Rand, they're going to have to issue 150 shares, isn't it? So the market value, which was 8 million, will now be spread among 750 shares, which was the old 600 plus the new 150. So the price per share will now be 10 Rand 67. So they used to have shares, the price per share was 10 Rand. Now they've got shares and the price per share is 10 Rand 67, isn't it? So they've got an increase of 67 cents. The existing shareholders own 750 shares, so they have an increase in value of 500. That's what we expect to see, isn't it? Because the increase in value is going up by 1 million. We're going to give 500 to the other shareholders, so we're going to keep 500 for our own shareholders, isn't it? If our own shareholders take up that or provide that capital, then they will get that return, our own existing shareholders. So that's the first option. The second option is where, and the question will actually guide you and tell you what they want you to check. Okay, so this question happens to look at value. We're going to look at a couple more questions that I'm going to hand out to you that used to be in your study guide, but now have disappeared out of your study guide. So I'm not sure why. So number 2 is to issue shares to new shareholders. So it could be that your existing shareholders don't have any more money to give you. So you have to look for new people to give capital to your business. If you issue shares to new shareholders, it's exactly the same story still, isn't it? Look, after takeover, it's 750 shares, 10 Rand 67. The increase in the share price is 67 cents, isn't it? Our existing shareholders own 600 shares. So their value will go up by 400 Rand, isn't it? The other 100 Rand will go to those new shareholders that are coming, isn't it? We're always looking at it from the perspective of our existing shareholders at the moment. So if we look at those two options, option 1 is better for existing shareholders than option 2. But if they don't have the money, option 2 is also good, because look, they're putting in nothing and they're getting value, isn't it? So they're putting in nothing in the second one and they're getting value. The third option is to borrow the money. This is still cash, eh? When we're looking at what is the financing, it's cash. But how do we get the cash? We get the cash now through borrowing. Number 1 was we get the cash from a rights issue. Number 2 was we get a cash from a new issue. Number 3, we get cash from a borrowing. So if we borrow this money, this 1.5, the way the calculation works is that we have a market value of 8 of our combined company. But now 1.5 of that is debt. So only 6.5 belongs to shareholders. Does it make sense to you? 8 value, 1.5 is debt, only 6.5 belongs to shareholders. So now 6.5 divided by 600 shares works out to 10 Rand 83 a share, because now we're not going to issue shares. Yeah. So at 10 Rand 83 a share, we have 83 cents times 600 shares is the 500 Rand. So for existing shareholders, whether we borrow the money or whether they give us the money, the benefit to them is the same, isn't it, to existing shareholders. Obviously, it has an impact on risk. It has an impact on risk. We've done that whole discussion, what happens if we take on more debt? The cost of equity goes up, isn't it? So there's all of that to consider. But in terms of dilution or somebody else getting your bit of money, nobody else is getting it, isn't it? If we do a share exchange, so if this is, and this is a fairly common way of financing mergers, is to do a share exchange. So you go to the shareholders of Company B and you say to them, you give us the shares in Company B, we'll give you shares in A. Yeah? So the old Company B will disappear, it will get liquidated, it will get absorbed into Company A, and then they get given shares in Company A. So the market, the share swap that we need to do is 1,500 Rand at 10 Rand a share, because we're giving them A shares, right? So we're going to give them 150 shares. Yeah. So we give them 150 shares. So the market value is 8. There's now going to be 750 shares. The value per share is 10 Rand 67. Existing shareholders own 600 shares, so their value goes up by 400. Yeah. So they're probably okay with that. Do you agree? There is where it stops for existing shareholders. Their value goes up by 400. They've put no money into the business, but look, their control has been diluted quite a bit, isn't it? Because they now own 600 out of 750. How much is that as a percentage? %. So whereas before they owned 100% of the shares, they're having to give up 20% of the shares to somebody else, isn't it? So their control is being diluted. It has an impact maybe on future earnings per share, dividends per share. We weren't given information about earnings or dividends. We were only given information about share price. Company B's shareholders, let's see if they would go for that. Because when you're doing a share swap, it's all good and well to say, yeah, let's do a share swap. My company's shareholders will be good with that. They'll be better off. They're happy with that. If you're proposing a share swap that Company B's shareholders are not happy with, then they're going to say, no, get lost, isn't it? So let's look at what happens with Company B's shareholders. They have 150 shares. Their 150 shares are at 10 Rand 67 is worth 1.6. Is that right? Just check it for me. 150 at 10 Rand 67. 1.6. Yeah. Their previous shares were only worth 1,000. Hey, remember right at the top we had a 1,000. So they get an increase in value of 600, which kind of makes sense. Why? Because they're getting the 500, which we said they're going to get that difference here. They're going to get that 500, isn't it? And now, because they are taking up shares in B, they're also going to get 20% of the other 500, isn't it? Which is the 100, which gives you 600. So that's an example of a financing in a merger situation. You could get asked a little bit of a theory question, isn't it, about how to finance it or propose or give ideas or advise. Or you could be asked to actually calculate the impact of certain financing on the company, and they would actually say to you, calculate the impact on price per share, earnings per share, etc. So as I said, I've got some examples which come from the previous study guide. Let me just see. Yeah, it starts there. I don't know why they removed it from the study guide. One thing that I still need to do is just to go through all the questions that they say you must do in Drury, just to make sure that there's nothing there that isn't something that we have done or that we would be able to do. Okay. All right, so the first question that I have, or the first example that I have, no, isn't even this page. It starts over here, but I didn't print this one for you because I thought it would fit better on one page if I didn't. It just says, assume that companies A and B agree to a takeover. A will be the surviving company. So A will take over B, B will disappear, it will get absorbed, and A is going to acquire all the shares of B in a one-to-one exchange of shares. Okay, a one-to-one exchange. The exchange ratio was determined by the company's share price. Okay, so this is the information before the transaction details are known. So A has earnings of 100,000, 60,000 shares. They have a PE ratio of 7.2. PE is price earnings, isn't it? So if we take, this here should give us the PE. That's the price per share. And if price earnings is a ratio of 7.2. If you divide 1200 by 7.2, it should give you the 166.7. If you divide this by this, it should also give you the 166.7. Is that correct? Just double check your numbers. Do you agree with that? So earnings over number of shares gives you earnings per share. Earnings per share share price divided by earnings per share gives you PE ratio, price earnings ratio, yeah? So they didn't even really need to give you all of that information. It's on page 133, right? It should be on the left side on one of your pages that you have. On this side, we have Company B. Company B only has earnings of 40,000 and they have 50,000 shares, so their earnings per share is 80 cents, but their share price is also 12 Rand, yeah? Also 12 Rand. So their PE ratio is much higher. Yeah. So although this company has higher earnings at the moment, their future earnings are expected to be less than that one, isn't it? Because the values are the same. And if you think about what is the value of a share, it's the present value of the future cash flows of that share, isn't it? It's all the future dividends or the capital growths if we're looking at selling shares. So obviously in the future, it's expected that this company will start to do much better and that their dividends will grow and theirs maybe will flatten out or something like that, because when we did the valuation, they came out the same, isn't it? The shares are trading at the same value. It says calculate the effect on the earnings per share after the takeover has taken place. Okay, so in this case, no synergies. Yeah. So after the takeover, we'll have A plus B. So let's look at what A plus B looks like. A plus B will have a total earnings of 140,000 Rand. And A plus B will have, we're going to do a share swap of 1 for 1, isn't it? 110,000 shares. 110,000 shares. So I want you to work out the earnings per share, but then I want you to compare that with what the previous shareholders had and what they currently have to look at that example. It's actually too easy, that one. What does it work out to be? 127.3. Okay, so at this exchange, they're getting 1 for 1. Hey, so they were getting 80 cents. They're now getting 127.3. They were getting 166.7. They're now getting 127.3. So at this rate of exchange, which is based on the market prices of the company of 12 Rand and 12 Rand a share, they are very happy. You agree? They were getting 80 cents. Now they're getting 127 cents. But they are not happy at all because their earnings per share is going to be diluted, isn't it? They were getting 167 cents a share and they're only now getting 127 cents a share. So if they asked you to do that and to discuss, let's have a look what they say. They say the market value of shareholders of those shares is 600. The new shares will be issued will be 50. Okay, that was obvious because it was 1 for 1. Since the exchange takes place on a 1 for 1, A will issue 50,000 shares to the shareholders of B, increasing shares to 110. A and B combined will be 140,000. The effect of the absorption on the merger will be that for shareholders of A, before takeover 166.7, after 127.3, shareholders of B before 80 cents, after 127.3. So when you look at the discussion, it says the earnings per share declined, where those of B increased. On the basis of this, it's clear that as original shareholders have been diluted, they might not find this acceptable and consequently might insist on another ratio of exchange or even cancel the transaction. So you can see you could have gone through the whole process, right? And then right at the end, when it comes down to actual financing and how we're going to pay for this, it might be that it doesn't work. One of the reasons that this one doesn't work as well is because there's no synergies, isn't it? If there were synergies, there might have been benefits even though you diluted. Yeah, we saw that in the previous example. In the previous example, even though we went from having 100% of the shares to having 80, there was enough synergy that it actually still made us have more money, isn't it? Whereas this one, because it has no synergies, we're just giving up money and we actually being diluted. The next example is, I think, a slightly more complicated one. So it says fast. just continues on your notes. Fast made an offer to the shareholders of Quick on the basis of 4 shares in Fast for every 5 shares of Quick. So the exchange ratio for the share swap is 4 for every 5, 4 to 5. The relevant financial information is as follows. Shares in issue, 200,000, 60,000. Earnings, 840, 168. Payout ratio, 30%, 40%. Net asset value, 6.4, 1.020. The share price, 51 Rand, 39 Rand. The debt to equity ratio, a lot of debt, a little bit of debt. Yeah. So both companies have paid dividends consistently in the past. So this is what they ask you. What is the total number of shares that Fast will issue to the shareholders of Quick? What is the value that's going to be placed on one Quick's share as a result of this offer? Advise the shareholders whether they should proceed with negotiations. Note any issues they should address during this negotiation process. And then it says, should Fast offer an additional 1 Rand per Quick share over and above the share exchange in cash? So that's like an example of a combination. Some shares, some cash. They're asking, should Fast offer an additional 1 Rand? Will this influence your initial recommendation? Look carefully at C. C is asking you to look at it from the shareholders of Quick's perspective, not the shareholders of Fast. Yeah. Remember when I said to you that when there's a share swap, you obviously need to make sure that your shareholders are happy. So look at it from your shareholders as well. But then you also have to make sure the other shareholders are happy, because otherwise they'll turn down the offer, isn't it? So it has to be an offer that both parties are happy with taking. All right, so try to do that one without looking at the solution which is on the back. Or have you already turned the page? No, you haven't. Your solution is on the back, so try not to look at that. See if you can do those calcs for me. Work out the... Okay, so assignment 3, which I went to look for, is the May 15 exam paper. It's not a submittable assignment. I should have brought the exam packs. I didn't bring. It's the May 15 exam paper, so there isn't any additional questions. I thought maybe there would be additional questions that we could do, and if one of them was one of these, then we could do it today, which is how I went looking for it, but nothing. Okay. Did you find it easy enough to do? The total number of shares that they will issue, they have 60,000 shares. Divide by 5 is 12, is that right? Times 4, 48. Is that what you got? 48,000 shares. Okay, then the next question was, what is the value placed on one Quick share according to the offer? Oh my goodness gracious me. I think I've got to close that door. It's the wind. So let's just have a look. 48,000 shares. The suggested share price is 5124 times 5 times 4, isn't it? That's the share price of the shares they're getting. And they're getting that for every 5 shares that they have. So they're getting 4099.20. So in that exchange ratio, this suggested exchange ratio of 4 for 5, they're going to get a value of 41 Rand almost, isn't it? 41 Rand. And if we look at the current share price, the current share price is 39 Rand. So they're going to benefit, isn't it? It looks like they're going to benefit. From a share price perspective, they will benefit. Okay. Then the next question asks you to look at whether they should proceed with, to advise whether they should proceed with negotiations. So they do some calculations. They do calculations looking at it from the perspective of Quick's shareholders. So combined Fast, the company, the joint company, will have this earnings, 1008, which was presumably the two added together. What was the two numbers? 840 and 168. So this is the combined. And they will have 248,000 shares, which is the 200 plus the 48 that we will issue for the share swap. And the earnings per share will be 406. Quick's books, the earnings per share was 280. Yeah, we can't really compare it exactly like that, because if we were to compare it, we'd have to times this one by 4 and this one by 5, because for every 5 of those, they're getting 4 of those. But even that looks like it will be good, isn't it? Do they do a calc like that where they actually multiply at the bottom, or not at all? There, yeah. Is it here? Where? I don't even see that. Over here. Yeah, so when we're looking at earnings per share, we actually have to say they would have had 5 shares, so that's 1,400, compared to 4 shares at that earnings per share, so it's that. So when we're looking at that earnings per share, it looks good, isn't it? They would go for that. So previous earnings per share, 280 Rand, they had 5 shares, now 406 Rand, they have 4. So that one looks good, isn't it? They then carry on looking at what will happen to the company. And when we look at dividends, dividends is the payout ratio, which was 30 for the one, 40 for the other. Is that right? So this one is just that times the payout ratio, that times the payout ratio, divided by number of shares, the same numbers we had above, and we've got 1,421 and 112. Again, this one would be times 5, this one would be times 4. It looks like dividends per share is not going to work out, isn't it? If we carry on looking, I would have preferred them to actually have done that straight away, but if we carry on looking down here, dividends per share, they were getting... What was this, 51? No. 112. Oh, there's something funny here. Hey, 112 something times 5. But it works out to 560. To 560. So here, dividends per share, they were getting 560 cents. Dividends per share, 560. They're now getting 4.87. So dividends per share, they're not going to really like, isn't it? So that one's not going to work out well for them. There was somewhere... no. Okay, so we carry on looking at the question. So we've looked at earnings, we've looked at dividends, net asset value. So net asset value of the two combined companies, 7.4 billion over 248 million shares, is 29 Rand, almost 30 Rand. Of the old company, 1 billion over 60 million shares, 17 Rand, 17 Rand. Again, we're going to have to do the times 5 times 4, but this one looks like they'll be better off, isn't it, with the times 5 times 4. They then take it through, which I prefer to see all together. Here we times by 5, we get 11, we get 8. So that one, they're better off, isn't it, from Quick's perspective.
Sorry, where did we get that 7 billion from? For net asset value?
Isn't it given in the net asset values are given in the beginning?
Oh, okay,
it's the two. It's the combined company, 64 and 1020. Yeah. So, because we're looking at Quick's shareholders, old, new. Old when they had Quick only, new when they were minority shareholders in Fast Quick, the new merged company. Let me see what else there is here. I think that was it, net asset value. Market value of Quick, market value of Fast, total market value of the combined. I think this is more or less what, we just, I think, did a quick look when we looked at the shares. Market value of Quick, 60,000 shares at 40 Rand a share. Market value of Fast, 200,000 at 51 Rand. That's the total market value of the two companies. If we divide by the total number of shares now, that will be the value, 51 Rand 24. So the previous, if we're looking at comparing, this is 51 Rand 24 times 4, and they previously had 40 Rand 92 times 5, and I think we saw that already, isn't it? That one also, I think, is worthwhile. They also look at PE ratio, so they take the 51.24 price over earnings, and they take, how did they get this price? What's that one? Market value. Oh, that's new. Oh, okay, so it's not that one that we're comparing. No, but there it says market value of Quick. Oh, it's the selling price. Oh, it's the selling price that we calculated. Okay, so that's not old. This is old over here, times 5. So it would be that times 5 versus that times 4. They just do a PE. It's a similar thing, I suppose. And when we look at PE, a PE actually works out worse. So this one looks good, isn't it? That times that market value. But PE ratio, because of earnings being so much bigger there, PE ratio is bad. So you just go through and do it. I suppose they're doing here as much as they can. Net asset value we look at. Cash value if shares are disposed of. So if they then take the share swap and sell the shares, they would sell 4 shares at 51 Rand, they would get 20,000. Currently they have 5 shares, they're trading at 39 Rand, they get 19,000. They get a bit more, isn't it? It's not massive. 800,000, but maybe it's millions, eh? Then it's 800 million, which could be a lot. So that says on the basis of increased earnings, increased book and cash value, we recommend that they proceed with the offer. And then they've got other factors to consider. Fast has a much higher risk because of the dividend to earnings ratio. They pay less dividends, hey, that one. So Fast pays less dividends. They have a lower PE. They have a higher debt to equity ratio, much more debt. And they talk about what will prospective growth be and what date the transaction will take place. Let's see what else I have. They say, will an additional 1 Rand influence your recommendation? You've already recommended that they go ahead with the transaction, isn't it? So an additional 5 Rand for every shares will make the cash values slightly different. But yeah, I don't know if that makes so much difference to the numbers. Okay, so they could ask a question like this. I was trying to find one, and I know that I've seen one in one of the assignments, but it wasn't. I'm trying to think if it was last year or the year before. Yeah, but I couldn't find it. It was definitely in one of the assignments where we had a similar thing that we were asked to do. But no, assignment. Have I given you any past papers for this module? Nothing at all. May 15 is the assignment 3 question. What is this now? Okay, here's a question that you can do. 2014 assignment 2. That was the one that I was looking for. Okay, so this is a typical question, a short one, 10 marks. It would more or less be around that. No, it's not that one. What am I looking for? Question 4. Hey, but this is what I've got here. Okay, so it's somewhat similar, the question. There's 2 companies, Titus and Castle. And they are looking at doing a takeover. Earnings per share is 50 Rand for Titus and 25 Rand per Castle. The price, the share price, is 750 Rand and 500 Rand. The PE ratio, which you can tell from here, is 15 and 20. The number of shares, 10 million and 7.5 million. The profit, 500 million and 187.5 million. And the value of the companies, which I think you'll probably find is just the price times the number of shares, is 7.5 billion and 3.75 billion. So what they're proposing is an offer whereby they're offering 2 shares in Titus for every 3 shares in Castle. The shareholders, the directors are of the opinion that when you take Titan and Castle together, that the earnings, the profit number, will increase by 10% because of synergies. So they ask you to calculate earnings per share accruing to the 2 shareholders. So the question is, I can just move it down, calculate earnings per share for the T shareholder and for the C shareholder. Assuming that there is the 10% increase, so they want you to do, number 1, a 10% increase in profit, and then they want you to do number 2, no increase in profit. Okay, and that's worth 10 marks. Okay, a typical exam question on mergers. And I don't know, for some reason, when you look at past exam papers and questions in assignments, they seem to prefer financing of mergers to valuations of mergers. They tend to ask the valuation questions in WACC. You know how we did those dividend valuations and all of that. So they tend to ask the valuation questions more in WACC, and then when we get to mergers, it's more like discussion and financing. Okay, which is why I'm harping on you being able to do these calcs. All right, so I'm going to let you try this one with no solution. I have a feeling some of you worked through the solution in the last one. Let's just call it a wild guess. But this one I want you to try do. So for 5 marks, for 10 marks, what is the impact on earnings per share for T's shareholders? This is their current earnings per share, 50 Rand. And this is their current earnings per share, 25 Rand. What will the earnings per share impact be for them in terms of percentages, increases and decreases, or rands, if they do the merger and we land up with a T plus C on a share exchange of 2 for 3. Okay, try to do that. I'm going to go and make you copies of this assignment. I haven't given you this one. I gave you one last week. Which one was that? Do you remember? 2014 semester 2. Okay, so this one is 2014 semester 1. So then at least I know I've given you those 2. All right, let's have a look. So if the earnings does go up, right, then the earnings will go up by 10%, and we will have total earnings then here for the combined company will be 500 plus 187.5 plus 10%, isn't it? What does that work out to be? Yes, on both. 10% on the synergy. I think it's 10% on both. What do you think? To both, to the total. Yeah. What does it actually say in the question in detail? Maybe you're right. It's the opinion that both companies will increase by 10%. Yeah. So maybe if you'd had the question in front of you, you wouldn't have made that mistake. Yeah. $500 plus 187.5 times 1.1, 756 to 250. Okay. Then the number of shares. The current number of shares there is 10 million, and then we're going to give 2 for every 3. So they have 7.5. So it's 5. So it's 5 million. So the new earnings per share, 756.25 divided by 15 is 50.42 cents. Okay, so if we look at it from the perspective of T shareholders, for every share they had, they still have a share, isn't it? So they, for them, old was 50 Rand, new is 50.42. So they are happy. Do you agree? So they are happy with the new. For Cassis shareholders, they had 25 Rand, but they had 25 Rand for 3 shares, and now they have 2, isn't it? So if we have to divide by 3 and times by 2, do you agree? No, times by 3 and divide by 2. Is that right? Times by 3, divide by 2. So times by 3 is 75, divide by 2 is 37.5. That was for every 1 share of the new shares they would have, isn't it? For every 1 share here, they used to have 1.5. So 1.5 times 25 is 37.5. And now they have 50.42. So both are happy. These ones significantly happier than those ones, isn't it, over there? So if there's synergy, even at an exchange that really favors the sellers, yeah, which in this case it looks like it really does, because you're going to be paying them for every 3 they own, they're going to get 2. So they're going to get 2 of those, 1,500 Rand, for every 3 they own. So yeah, so it's a share swap. It's according to market value, the share swap, really. All right, so let me undo that. It's just confusing up there. All right, so then the second part of the question asked you, what happens if there is no increase in profit, isn't it? So if there's no increase in profit, what is the cents per share? It's 500 plus 187.5 divided by 15, 45.83. So if there's no increase, then it's 45.83 versus the 50. And here it's 45.83 versus the 37.5, equivalent 1 share. So in that case, they are still happy, but now they are not happy anymore, isn't it? So it's very important for this share swap of 2 for 3 that there is synergy. It's important that when you do the, it's important when you do the share swap that there is synergy, that we can increase profits, because that's what's going to make that company worthwhile, isn't it? And I think the reason for that is this higher PE ratio that we see happening over there, because we're giving them 20 Rand for every 1 Rand of profit, and my existing company is only getting 15 Rand for 1 Rand of profit. So, yeah. Okay, so that would have been worth 10 marks in the exam. Okay, so we are basically almost done. We have 1 module left, which we're going to do next week. Next week is lecture 10, and it's going to be Forex, interest, and dividends, which is small topics, but they can each come up for a few marks, and typically do come up for a few marks. Yeah? So that's lecture 10, and next week is what date? The 20? Next week is not the 20-something, it's the 13th. Okay, then we have a problem, because for the rest of the month, we then have the 20th, the 27th, 2 lectures, 2 days. And this day is a public holiday. So we actually have 1 lecture left, which we will use to do the October 15 exam. Okay? We will start the October 15 exam next week if we can. If there are some of these questions in there, we'll do them. But then it means that we have 2 lectures to catch up. Essentially, the one for the holiday that's still coming, and one for the week that I was away. Okay. So the options for catching up those 2 lectures are Thursdays. I can do from 10 o'clock till 2 o'clock, or from 10:30 till 2:30, anything like that. Yeah, on a Thursday. Or I can do Friday mornings from 8 or 8:30, whatever time we agree. Also until more or less, until 1:30 on a Friday. Alexa finishes school 1:30. But we also need to take into account that this exam is only on the 15th of June. Okay, so I need to have an idea more or less what you're thinking. If you want to just get it done on a Thursday, then we come in on a Thursday and we get it done. No? You've got lectures on Thursdays at that time. We're going to do past exam papers. Closer. How much closer?
So like the beginning of June. Because I think most people are done with most.
Can we agree on a date? Can we tentatively agree on a date? Yeah, because you don't plan to be here. After the 30th of...
Okay, when do you finish your exams? Like, you know, for May. Finish on the 30th of May.
The 1st of June is a Wednesday.
I'll put an economics paper on the 2nd of June.
Okay, so the 1st of June and the 2nd of June is out. The 3rd is the 6th is a Monday.
That's a week.
A week and a bit before, because you write the next week on the Wednesday. Okay, and you want to just do a double on that day. 4 hours that morning. So what time do you want to do? 9 to 1, 8:30 to 9 till 1, 9, 10, 11. Okay, 9 to 1. Okay, so the 6th of June from 9 to 1, we'll do the rest of the revision classes, which is going through past exam papers. But I am going to try from next week. We're going to be able to do that, I think, fairly quickly. We're going to start this October paper. So between next week and the 20th, we'll finish that October paper. The rest of the papers I will give you. I've got solutions for the rest of them. There's not a lot of past papers. The past papers only go back to 2014, so there are only 4. So there are only 4 past papers. 3 I've got solutions for. The one I don't, we're going to work through together. And then when we come back then, we can go through those past papers or go through, by then you would have studied, hopefully, right? Or not? And then we'll, if there's anything that's worrying you, that you feel you need to do extra work on, we can deal with it then in that 4 hours. The crash course, there is a crash course. It's, I think, on a Sunday, sometime in May, end of May, I think, as well. But what I'm going to say in the crash course, you've already heard me say, so I don't think it's worth your while unless you've really missed to come to that. You're going to just hear me say the same things that I've already said. Okay. All right, so I'll see you next week.